if we have some crazy event that happens in our world, that's going to impact that company for a minute or for a day, right? A couple days maybe, and you'll feel it and your value's going down. But over the long term, is that really going to impact that company or not? And you really have to look at that level. So I'm confident. I think our world is competitive, and that competition is good for stocks.
What will you do when your money works for you? Welcome to the Tech Girl Financial Podcast with your hosts, Victor and Kim GAXIOLA. From the home office in California, here is Victor and Kim.
Okay, I hope everybody's prepared to listen to Kim completely geek out, because we are now treading into her waters. Investment strategy design. So are you excited?
It's my favorite topic.
Why did it take us so long to get to this topic? It is funny because I was thinking about it. So we're done a couple podcasts. We certainly have had some amazing guests, in the financial professional series with Jenny and Janine. And the feedback from those shows has been outstanding. So thank you for listening. We will have more financial professionals in future shows. But in looking at the episodes we've done, we realized we hadn't actually done a podcast yet to really talk about the nitty-gritty, getting deep as it relates to designing an investment strategy. So we covered some of the first stages, right, with the financial planning.
And so, Victor, you like to talk about the steak and the sizzle.
Yeah.
You're really good at the sizzle.
I'm the sizzle. You're the steak.
I like the steak. So I like to think of this investment piece as the steak. This is like this is it. The protein.
Yeah. It's making me hungry now. So explain why. What do you mean by that?
Well, you got to have protein to sustain your energy level, right? Mm-hmm. And it's the investments that are going to make your plan go the way you want them to go.
Right. So it's not enough, to sit there and you can plan all day long, right? But until you bring in the steak, the protein that you mentioned, things aren't really going to go anywhere. So we spent a whole episode just talking about why the financial planning process really matters in identifying goals, assessing people's current assets, identifying their tolerance for risk, which is an important component, and then creating scenarios and what ifs for them. So we walk through that. We talk to a client, we talk to a prospect, we go through that whole process, and we identify what needs to get done. This is really now the next stage of how you get that done.
Yeah. So I think back in the day, in our planning conversation, we were talking about our imaginary clients, Keegan and Taylor Rosen. And so, we put together a plan for them to help establish where they're going in life and how their money will get them where they want to go. But it is absolutely meaningless if you don't have the right investments implemented to make that plan happen.
Yeah, and you can use all kinds of analogies, right, when it comes to it. Like the one I use a lot is the planning process is nothing more than like working with an architect that's going to design the blueprints for, let's say, a new home, if you were going to customize a home. And that's great. It's a great blueprint. You look at it and say, this is outstanding, but the people aren't going to be warm and fuzzy in that bed, in that new bedroom, unless they actually build it. So that's really where the investment strategy comes in.
That's it. So it's really important to get this right. It's really important not to plan and be overly optimistic with your portfolios because, we want to be on the conservative side and make sure you get there. Another way to think about it, I like to think of my software as like the Waze for people, the financial Waze. And really, Waze is only good if it's predicting your speed level. Mm-hmm. And so, we can talk about investments and everybody, some people might roll their eyes and think that this is going to be a big snooze fest. I'm aware of that. You won't hurt my feelings. But what I would say is, there's a lot of different cars you can drive and still have access to Waze, right? Mm-hmm. And it's going to determine how comfortable you are on your way there. Mm-hmm. And so really that's like the investments. It shouldn't be too complicated. whatever we pick to put into a portfolio is like a different type of car, right? Different models and makes, and how are we going to get there?
Mm-hmm. So let's take a big picture view of this. So when it comes to investment strategy, a lot of people hear about passive and active strategies. So what is the difference?
So that's a good question. And when we talk about passive and active strategies, really you're talking about two different types of investment strategies for your portfolio. One is passive, which means, you're just going to buy a bunch of index funds and follow an index. Mm-hmm. The other is active, to say that you believe that having a manager run the money and make decisions, buys and sells based on what is happening in the current economic environment, is the best way to go for your portfolio. Mm-hmm. I wouldn't say that one answer is right all of the time. There's going to be times where passive beats active, and there's going to be other times where active beats passive. Mm-hmm. The only thing I will say is when it comes to fixed income, I am almost always biased towards active management.
Okay. All right. So you just introduced the idea of fixed income. So what is fixed income?
So fixed income are bonds, quite simply. Mm-hmm. And if you don't really get a good idea of what a bond is, think about a loan, mm-hmm. An IOU, where an investor loans their money to either a company or a local municipality or the U.S. government. Mm-hmm. And in exchange, they lend that money and they take on a certain amount of risk because they expect to be paid back. Mm-hmm. And in return for lending out that money, they get a rate of interest.
Right. So when you're looking at portfolio construction, it's typically going to be a combination of fixed income, something that's geared more towards growth, which might be include a little bit more risk than the fixed income, and then maybe cash. And so those are usually the simplistic ways when you look at a portfolio, right?
Right. And I think, you want to look at it as the stocks are typically for the growth, and the bonds are typically for income, and also to act as, going back to our car analogy, mm-hmm. as the shock absorbers, right?
I like it.
So you have those there to protect yourself in hard times. And when we have hard times, we will always have hard times in stocks. The bonds will make your ride a little bit more smoother.
Mm-hmm. So when it comes to evaluating, the different types of investment products or different investment strategies or approaches, it is like coming up with the appropriate recipe, right, for the individual. And so I think that one of the benefits of working with a financial professional or working with someone like you who does this is, now that you've recognized what the person's goals are and you've developed a plan, it's really coming up with the best customized recipe of investment products that's going to help them get them there, right? So what's that process like?
Okay, so the process is a lot of conversations with clients to get an understanding of what can they tolerate, mm-hmm. right? This is a matter of risk tolerance. And I always like to say that somebody should be pushed a little into their discomfort zone. Mm-hmm. I don't know how to say that, if mm-hmm. I'm saying it right or not. But, I love to work out. And so I like to equate it with my workouts. Mm-hmm. If I have no pain, there is no gain. Mm-hmm. And, that's like looking at my muscles and all that stuff. And so, however, I'm not going to put too much pain and stress on the weights when I'm working out, because I also know that I could have an injury, mm-hmm. right? And so it's the same thing working with investments. Is I want something that's going to push the client a little outside of their comfort zone in order to get that to grow and to meet their needs, but at the same time, not too much risk and not too much discomfort that it will cause them to say, forget this. I can't be in here anymore, sell out of everything at the wrong time.
Right. And there is a very large, broad-based selection of the types of investments that you can put someone in, whether they're stocks, and even within stocks, you can always peel the onion even further between growth-oriented stocks, large cap, mid cap, small cap, international. You know what I mean? So every one of these investment solutions is going to have various degrees of complexity. Mutual funds, which people are very familiar with in their 401ks.
Right. And now, we bring in the element of exchange traded funds, or ETFs is what we like to call it. There's so much lingo in this business that we're all using it. And so what I would say to somebody is to really understand that whether you're investing in an exchange traded fund or a mutual fund, or even a unit investment trust. I'm trying to think if there's anything else in that group that I'm forgetting about. The underlying investment is either going to be, for the most part, stocks or bonds. And I say in general, because there are a lot of special funds out there that may be investing in other things. But in general, if you're going for a growth mutual fund or a growth exchange traded fund, the underlying investment is stocks, right? It's kind of like, I don't know, I love analogies, so I could do this all day long, right? It's the ingredient inside there are going to be stocks. And if you're looking for an income or a low risk investment and you invest in a mutual fund or another exchange traded fund, the underlying ingredients to that fund are going to be bonds, just different types, depending on, how much risk you're going to take. So it's really a good idea to understand, how much detail somebody wants in their portfolio. I love the detail, but I know not always do clients want all of the detail. However, I do think it's important for them to have some level of it, because with detail comes transparency. And what I mean by transparency is you really should understand what you're investing in, right?
And even if that does, as you said earlier, cause a certain amount of discomfort, because my recollection was that a person's portfolio isn't fully diversified, because that's a big question, right? Is it diversified? Do you have exposure to all the different facets, especially if you're trying to match it to some sort of investment strategy? That if you're fully diversified, that at any one time, there's probably something in your portfolio that's underperforming, but that's okay, right?
Right. And I would say this too. I would probably make a statement to say that the majority of people, I think, are over diversified.
Wait. What do you mean by over diversified?
Okay, so we have mutual funds and exchange traded funds, index funds, and all that kind of jazz. And you have a lot of different options. If you're married, one spouse has a certain set of funds, and then the other spouse has a different set of funds. And then, you have additional investments outside your 401k. And we can go on, and we could say that by the time you tallied all the stocks and all the bonds that you're holding and all of those funds that you own, you could potentially have thousands of stocks.
So when you're looking at, let's say, a portfolio, you're not looking at it just then as an individual basis. I mean, you're doing both. You're looking at an individual basis, but you're also looking at it at a household basis. Right, because if you've got two people, going back to the example before, that one might be really conservative, might be really aggressive, but then when you combine it, it kind of balances each other out. Are you looking at the big picture?
Yeah, I'm looking at the big picture. And how much opportunity do I have in this situation as far as making recommendations and getting them to implement those recommendations? So it's ideal when I am working with the husband and the wife, or, two spouses, because then I can talk to both of them and look at both of those portfolios and recommend complementary investments in each portfolio. But sometimes I'm only working with one spouse, and then I can really only control sometimes what that one spouse that is working with me is. And so I'll do the best of my ability to do that and complement the other things. But overall, I really want this portfolio to be in a position where, number one, they can tolerate it, be slightly uncomfortable, but tolerate that. And two, get them where they need to go in the time that they want to make that happen.
Mm-hmm. And so going back to the conversation around planning, this is why it's so important for you to also understand some of the holdings they may have in their other retirement plans, things that they might have at work that maybe you wouldn't have direct visibility without them giving you permission to look at that, so that you can get the best view of their entire financial picture.
Absolutely, because that, it's all part of their net worth, right? And we're going to look at how much you own versus how much you owe. And one of the things that comes up a lot here in the Bay Area are a lot of my clients own their company stock. Mm-hmm. And so that is something that may not be under my control, but I can help them look at that and say, hey, we should consider sell strategies over time in order to make sure that you don't become overwhelmed by one holding. Mm-hmm. Because if something goes wrong, it always does after it's too late to do anything, mm-hmm. right?
Mm-hmm. So you talked about the need for diversification. You talked about the fact that people could have potentially a large concentrated position in one single holding, which mm-hmm. doesn't help them, because then things can be a little out of balance. What are some of the other common mistakes that you might actually come across or concerns when, let's say, you are reviewing someone's investment strategy for the first time?
Yeah, so a lot of times I hear that people want to diversify where they're holding things. They may have an account at Fidelity and then Charles Schwab and E-Trade, and they think that they're diversifying their portfolio that way. And that's truly just a myth, because when you look at what they're holding inside those brokerage accounts, a lot of times it's the same exact thing. Mm-hmm. And so if you're with a reputable firm, a brokerage account, then you shouldn't be worried too much in diversifying yourself from one broker to another, because your holdings are protected within your account. Mm-hmm. And, all brokerage firms that we work with, all the reputable ones, have the SIPC, which is the insurance to protect you against fraud at the brokerage firms. And then, all of your accounts are held in your name. And so what's in there, the risk you really have is the market risk and the investment risk. Mm-hmm. And that is a whole different diversification topic.
Well, I remember in the podcast we recorded where we were talking about, Marie Kondo, your finances, that one of the recommendations was exactly that, is to looking for opportunities to consolidate, so that if people have, multiple 401ks, if they had different employers, to try to bring that under one roof or under one account, if possible, because then it gives them not only a little bit more control and transparency into their entire holdings in one place, but at the same token, there is that benefit that if you have a concentration and consolidation into an account, that maybe the accumulation of all those assets now actually open up new investment options for you. And what I mean is that there's certain minimums in some cases for certain options that through that consolidation, they now have that opportunity to participate.
Right. And that's so important because, it's kind of like going to Costco and buying all your food in bulk there. The more you have in one place, usually you get some discounts for buying in bulk. And so that's one important thing. The second is that when you consolidate it and you're working with an advisor, well, then, your advisor can make the recommendations and implement the investments so that it's in conjunction with your plan. Again, going back to say, okay, what are we planning for, and how are we making sure that your investments are the right investments for the plan to work in the time allotted, right? And so it's really important to have those working together in sync. When you have different people in different jobs, then you're not guaranteed that. So that was really important, number one. And number two is, I think, this gets to my favorite topic of stocks. And I would say that, once you have a larger size portfolio, then we can make a customized, let's just call it a customized mutual fund for you. And what I mean by that is you holding the stocks in your account instead of having a mutual fund that holds the stocks in your account. And the reason why I like this is because a lot of the companies that we are buying are names that you know. And so when we have the next 2008, 2009 market crash, if you're holding on to companies that you know, maybe you even shop at those stores or buy those certain retailer items, then you're not going to be so worried when the market goes down. Because let's put it this way, it's going to take a lot for Coca-Cola or, I use that in general. It's not a name in my portfolio, but if you have a name that you know, and that is a very big company, that even during a recession, people are continuing to buy that product. So I like people to own companies. That's one of the reasons why I love stocks is I love people to know what they own. These days with the internet, you can, if you don't know what company is in your portfolio, you can always do a Google search, right? And figure out what that company is and what it's doing. And if we don't want to do it into micromanage it at a stock level, I do work with a lot of sector portfolios as well, because I think it's very intuitive to understand we're going to buy tech stocks or we're going to buy utilities. And why do we buy these things? Well, maybe you're going to buy more utilities when you think the market is going to go down because it's a less risky investment than tech stocks. So, we look at all of these things and we want to make it pretty easy for people to understand. Whereas, there's sometimes a lot of mutual funds. I don't know how many mutual funds there are out there, thousands and thousands. And if we said, okay, let's just look at all the growth funds out there, that's not a very big filter, right? Because you're going to, again, still have thousands of growth funds. And how do you know one from the other, right? And when the market goes down and you have that growth fund, you're like, I'm paying all these fees and I'm not sure where they're going because I still own this growth fund and it still went down. And number one, I always want people to know a little bit more about what they own.
Okay, so we're talking about investment strategy design. We've talked about diversification. We've talked about the balance and the mix as it relates to, how you balance that portfolio with fixed income or stocks, bonds, and the different facets. So, Kim, I know that you probably get this question quite a bit, but in your opinion, how often should people really be looking at their portfolio?
That's a really good question. And I wish I had a direct answer for that, but it would depend. What kind of investor are you? And are you my client or are you just someone managing your own portfolio, right? Mm-hmm. Because based on those responses, it should be a different answer, right? And so, I can tell you what it's not every day.
Well, you mentioned before that, one of the things is that one of the biggest changes I think that's happened in the last 20 years is the fact that people now have so much access to information. I think statistically or somewhere I read that today's investor through the internet has just as much information as institutional investors used to have maybe 10, 15 years ago. So the access to information is definitely there. And that's a good thing from a transparency standpoint, but it's a bad thing from the standpoint that people left to their own devices aren't necessarily investment specialists to really know, the right direction to go. And so we can all be very familiar with like name brands, stocks and things that we purchase on a day-to-day basis. Or if you open up your pantry or refrigerator, you'll come across a number of big names and you recognize that. Or if you watch, enough television or you go to the movies, you'll see all these different products. And so people can feel very comfortable, knowing what they own. And then, like you said, they can go to Google and you put the money sign and the letter code or whatever the stock symbol is, and can get real-time information about not only what's happening with that stock now, but what's happened to it before, the historical charts, and all this. And it's almost like too much information. And so I think people can put themselves in a position where they almost have too much information that it might keep them from taking any real action. Mm-hmm. Right.
We call that in our world analysis paralysis.
Yeah.
Right.
Right.
And I mean, okay, it's like going to a restaurant, In and Out. I know immediately what I want to order on that menu because it's very simple. And then go to Cheesecake Factory. It could take me a half hour because it's a book.
It's a book.
Right?
It literally is a book.
Yeah. And so the same thing happens here is like when you have information overload, you get so stressed because you think you should know everything. Mm-hmm. And it's impossible to know everything. And so you just put it off and don't do anything. Mm-hmm. And that is not the right answer. It's, don't postpone it, just tackle it. And if you do not like to read that kind of information and get involved with it, delegate it out.
Right. Well, I think I remember, this is years ago, but I do remember that there was a time when the price or the current value of a mutual fund was only printed in the newspaper, I think once a year, right? And now you can get that information daily, right? Daily information. And so the analogy I used to love was when they would say that would be like trying to bake a cake and opening up the oven door every minute just to check what the progress is. Well, you keep opening that door and it's hard to see any sort of real progress if you're checking and opening up that door every minute.
Yeah, and that's what, we could blame on the internet. I love going online and finding out whatever I want in a second. But, the internet brought on online accounts so everybody can go on daily and look at their accounts and see what the value is. And that's not necessarily a good thing. I mean, I think it's great that you have access to the information. But if you're looking at it daily, as opposed to the old school way, which was get a statement at the end of the month or at the end of the quarter, and some at the end of the year, and then make a judgment, based on year to year changes versus day to day.
Right.
And, the same thing with what happened when we all of a sudden had 24/7 news, and there's probably like 3 or 4 different financial news channels that you can listen to 24/7. Mm-hmm. And it's like, that much information isn't always the best thing when it comes to looking at this stuff. I mean, me personally, I'm involved with this and I'm managing for a lot of clients. Every morning I'm looking at the headlines to see what's happening. Even I do this every morning and it doesn't seem like there's that much change from one day to another.
Right. I think what we're talking a lot about here is just noise, especially in times of volatility where a lot of it is noise and it's a lot of distraction. And if you really are helping individuals plan for a long term, whether it's 20 years away or 30 years away if they're preparing for retirement, or let's say some goal that they have set out way in the distance, then the day-to-day fluctuations is having very little real bearing on them being able to achieve those goals 20, 30 years out.
Right. So that goes into another myth that's interesting to talk about is the person that is really worried or overly pessimistic about what's going on in the world. Mm-hmm. We can go from day to day and see the headlines of all the bad things that are happening out there. But when we take it back to how do your investments grow, they grow by the individual companies growing. Mm-hmm. And now we have to look at corporate America and know that every single person that is hired at a company is hired to do a job better, more profitable, and grow bigger and bigger. That's the guidelines of all companies. And now we've added another guideline is to do it in a socially good way as well. But in general, the idea, in corporate America and in corporations around the world is to grow your business. And so what you're evaluating really should be, how well is this company doing that? And what's the opportunity for growth in the future? It's not about what happens here or there because to be honest, that will create if we have some crazy event that happens in our world, that's going to impact that company for a minute or for a day, right? A couple days maybe, and you'll feel it and your value's going down, but over the long term, is that really going to impact that company or not? And you really have to look at that level. So I'm confident. I think our world is competitive, and that competition is good for stocks.
Okay, so I've got a portfolio and it's been invested a certain way now, let's say for about a year. And I hear a lot about the need for rebalancing. So what exactly is rebalancing?
Okay, so what rebalancing is to say, in simple terms, if you had 50% of your portfolio in a growth stock fund and 50% of your portfolio in a bond fund, and let's say you set that up a year ago, and today you look at it, and because stocks have grown more than bonds, now you have 60% in your stock portfolio or your stock fund and 40% in your bond fund. And so the idea is that to keep your investment objectives right on target, which was 50% in stocks and 50% in bonds, you need to sell the 10% overweight in stocks and put it into bonds.
Oh, so bring it back into that equilibrium of 50-50.
Yeah. And it's a nice idea because really what you're doing is you're selling at a high because the stocks have gone up in value and the bonds have gone down in value. So you're selling the stocks at a high and buying the bonds at a low. And that's the basic way to make money in stocks as bonds is buy low and sell high.
It still holds up. And how often do people typically do that? I mean, when you make a recommendation, does it depend on the person, or is there usually an appropriate clip?
So one thing, it's a great question, and one thing we haven't even touched on is fundamental versus technical investment strategies, which I like to do a lot of both. Fundamental means you're investing in good companies that have a reputation of strong growth trends and has a big place in the market or what have you. Lots of different things. Fundamental has to do it.
You're looking at the management.
You're looking at the books. Right?
You're looking at the management. You're looking at their products. You're looking at basically the makeup of the company.
Right. And then the technical way is just to look at the chart of a stock and say, all stocks go up in value with an increase in demand. And so a technical person will believe in trends. And so I bring that into the conversation because if you were to rebalance too often, you're not going to take advantage of those trends, right? So right now we've been in a market where stocks have outperformed bonds for a long time. And there's very few instances when bonds outperform stocks because it's the nature of one is for growth and one is for income. However, if we were to break it down on an even more minuscule level, then we could see trends in different things like technology stocks doing better than utilities or healthcare or what have you. And so if you sell those portfolios too often, which is what you're doing every time you do a rebalance, you may not take advantage of those runs. So what I would say is, not more than 2 times a year would I do a rebalance. But there are options for more than that. And, I guess you could say it has to do a little bit more with your risk tolerance as well. But I think that doing it more than 2 times a year is a lot.
Which coincides with really the review process with clients, right?
Yeah. So depending on the size of the portfolio and the nature of the client, we're always doing reviews on the actual investment. So let me put it clearly on this. There is rarely a day that I'm not reviewing an investment. And so, but that's my job.
Yeah, it is.
And so I'm doing that for my clients are hiring me to do that. So I'm looking at that all the time.
That's the steak.
Yeah, exactly.
On the sizzle.
Yeah. But, so I'm constantly evaluating these investments to make sure that I'm always holding the right investments. But then when it comes to on a client level, at least once a year, but for some clients, it can be more like semi-annually. And, there are others that it may happen 3 times a year. But usually when I'm looking at it, it's not to make changes every single time. Right. And, so yeah, when I'm looking at it, it may not be always just for the rebalance purpose, but it's also to make tweaks on the portfolio.
I love that word.
So
Tweaks.
yeah, I like tweaks more than rebalances because I think that describes what we're doing.
It's like a course correction, going back to your ways, like you're going to your destination, you're just making little adjustments here and there.
Yeah, and rebalance means you're just going back to the same old thing. And, our economy changes. It's cyclical. It goes up and it goes down over time. And so I think that people are hiring me to take notice of what's happening where we are in the economic cycle and make sure that their portfolio is current with the economic cycle and with their feelings towards risk and investment objectives.
Yeah, I want to expand a little bit on that, towards the feelings towards risk, because you've been working with some folks for a long time. And I was just curious, do people's risk tolerance change over time?
Yes, they do. And that's a funny question because I can tell you people's risk tolerance changes when the market is going down.
Yeah.
And then changes again when the market's going up.
Yeah. What about the age 60? I heard that 60 is like this fulcrum where they can be really growth aggressive, and then they turn 60 and all of a sudden, now they got to be real conservative.
Yeah. I know that's kind of a rule of thumb, but it's not like a light switch that turns off and on. I think it's more of a dimmer, right? You can dial it back and dial it up. And that's what, that's my job, is not to turn it off and on, but to do the dimmer switch. And because it really goes back to I have clients that are 70 years old and they do not want to take any income out of their portfolio. And so if you are going to be in a portfolio where you're not needing the income and you're investing it more for legacy purposes, well, then you can afford to take more risk if you feel comfortable with that.
So that brings me up to one thing, Kim. So from your experience, do you see that there's a tendency, obviously, as people get a little bit older, they get maybe more conservative in their portfolio, but to a certain degree, they don't have enough growth, like from the standpoint that I think that there is that myth that people just stop investing in growth as they get older because they're really trying to conserve more.
So that's a good point to make. And I would say the majority of the portfolios that I see are my clients.
So they're fine. They're good.
Yeah, they're fine.
Don't worry about it.
I know what they need and what they don't need and how to invest for them. But I would say if I was to take a look at a bunch of investors that didn't have an advisor helping them, I think I would find that people are, in general, tend to be more conservative when they're older. And whether that's the right thing to do or not is entirely dependent on what your needs for that portfolio is.
Right. So it is very much a customized recipe on a person-by-person basis.
Right, no matter how old you are.
Right. And that's the thing. I think that people have a tendency of thinking that, younger people are going to be all growth-oriented, but you can have some very conservative clients even in their youth, right?
Right. And, that when you have somebody that's really conservative and they're in their youth, that's when education is so important, because we need to educate them that, you have all your money in CDs, you are probably not going to reach all of your goals. So, Victor, one of the things that I have a hard time with is not giving people a straight answer.
Yeah. Well, I know that better than anybody.
Right? I mean, yes or no, or, give them some conditions or something like that. But in this world, there's just no doing that until I totally know the investor that I'm working with. Which brings up the whole idea of, this is a process. It's a custom process that we do with each and every individual.
So coming up with their own individual recipe.
Right. And so that's why it's really important. If you have doubts in your portfolio, or you're confused, lost, or just flat out don't like doing this.
If you're stuck on the side of the road in that ways of your life, trying to get to your destination, but you don't even know where to start.
You won't hurt my feelings if you tell me I don't like doing this.
Yeah, and people don't.
Yeah.
There are some that love it, right? And those are usually the ones that are in, watching and checking their account portfolio values on a daily basis. But I think that a lot of people are really more of a set it and forget it. They get that 401k allocation every year and they sit there and they just make their selections, and then they forget about it. They don't even bother with the rebalancing at all, ever, or making tweaks. They just leave it as is. And fingers crossed and hope for the best. And as you have often say, hope is not a strategy.
No,
that's why you need to work with people.
No, it's not a strategy. I love that. Hope is not an investment strategy, and we do not use hope in our portfolios.
It's not part of it. Yeah.
Yeah.
So if you're interested in finding out, is my portfolio structured appropriately? Am I doing the right things? I'm stuck on the side of the road and could use some help. Please contact us. You can come to our website. Go ahead and click contact, fill in some information. We'd be happy to help you out and talk to you. While we're on the subject, I also wanted to bring up some additional resources that are new to the website, and that is we have a number of downloadable resources now. This is guides and checklists. So if you want to, find out what should you do with your old 401k or the employer plan, come to the website, check out the resource section. You can also get a guide on the 3 money moves, life insurance reviews, different areas that relate to volatility. It's a new section on our website which has all this great information, and we really think that informed investors are better investors because they've got the information to make better decisions. That, and in addition to that, Kim and I are also now have a new speaker section on our website. So if you're a conference, you have a conference, or if your company is looking for speakers or people to talk about the subjects that we regularly talk about on our podcast, you can go to the speaking section. There's a number of presentations that we can do, as well as an opportunity where we would be happy to be, either Kim or myself, as part of a panel or to come educate the folks in your workplace.
Yes, I love giving education. It's my favorite thing to do. So think of your alumni organizations, your professional associations, any of those types of organizations. I am happy to come out, and so is Victor, and give a presentation and just educate you.
Yeah, and I can juggle, and Kim can do cartwheels. So, all that good stuff. So that is the exciting 2 new sections of our website. And then the last thing I'll do, and we haven't done this in a while, and that is that we encourage you, if you have a question related to any of the podcasts, or if you have a specific subject area you'd love for us to explore or expand on, please send me an email at victor@techrollfinancial.com. Or if you are on Twitter, you can use hashtag AskTGF. Reminder, we're also on Instagram, and we do read all the comments and things that people post. And we're always looking for, feedback on what you like about the show and what you'd like us to do different.
Yeah. So, Victor, what's the dumbest question you've ever been asked?
Oh, my God. What a question.
I could tell you the answer.
What's that?
It's the one that You haven't asked.
Wow. You're like a little Buddha over here. All this wisdom. Oh, man. I love doing this with you, Kim. This is awesome. So we want to thank everybody for listening. And as always, we remind you, what would you do
when your money works for you?
That's right. See you. We'll see you next time.
Bye.
Bye.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. Tech Girl Financial and Cambridge Investment Research, Inc. are not affiliated companies. These are the opinions of Victor and Kim GAXIOLA and not necessarily those of Cambridge. They're for informational purposes only and should not be construed or acted upon as individualized investment advice. Diversification and asset allocation strategies do not assume profit or protect against loss. Past performance is no guarantee of future results. Investing involves risk. Depending on the types of investments, there may be varying degrees of risk. Investors should be prepared to bear loss, including total loss of principal.
I'm just going to wing this.